Hey, what's going on, everyone? It is video 3, so we're going to change the order slightly. I'm going to move the balance sheet stuff up. So we're going to be looking at the balance sheet this video. Previous videos, we looked at the income statement and the cash flow statement. That was video 2. Next, we need to... Oh, the previous one before that was inputting transactions for the month. So we're really getting the whole thing. And then after that, we're going to be doing some theory. So that'll just be walking you through some theory and unpacking all that. So in the interim, let's quickly recap what did we do the previous video. So you can see that the first things first, we've got a cash flow statement. We saw $1,073. We then have our income statement, which was 1370. Now today we're going to be doing some calculations. Sorry, I should be adding a few other things plus GST. Oh, sorry, just adding some little bits and bobs there. Okay, just a heads up. Now, we're going to be calculating the accounts payable, accounts receivable, GST, and then looking at the balance sheet, and then that'll be wrapped up with our elements. And we're going to be able to see that, and then we've got some worked examples I'm going to go through. So let's crack to it. So let's do our calculations first. So we'll start with accounts payable. So accounts payable, the balance at the start was 0. Now, the reason it's 0 is because it's a new business, and so you just go by the previous month's balance sheet or the amount you're given. We add credit purchases plus GST. So we find our credit purchases. That would be in the purchases journal, and we go top bottom corner, which is 7,700. Wherever that is, 7,700. And that gives us a subtotal of 7,700. We less the payments to accounts payable. So we find our payments to account payable, which was 3,000. And we see that it doesn't line up, but the general idea makes sense. And that would be our accounts payable balance at the end, and it should be 4,700. Accounts payable 4,700. We need to pay it back, so it is a liability. Let's put that in now. Accounts payable 4,700. So we then move up and we do the accounts receivable. So accounts receivable at start again is 0. Now we add the credit sales including GST. We look for the credit sales including GST, which will be the sales journal 9350. 9350. And we see the subtotal 9350 less payments from accounts receivable. We can go to the cash flow statement this time and we see 4,500, and that will give us, oh no, we've got sales returns. Now, if there are sales returns, you need to factor that in as well. Same if there's purchase returns. Purchase returns would go here. Same concept, but no purchase returns means I'm not going to include it. But just make a note, purchase returns will go in the accounts payable. Less sales returns, and we need to include GST. So let's have a look there. We see, if we go all the way up, we see sales returns for the month was $2,000, and that should be included plus GST. So we would add $200 because 10% of 2,000 is 200. So it becomes 2,200. So just give me a moment to get back down there. 2,200. And the amount now is, let's bring up the calculator. Oh, haven't got the calculator up. Now we do. You can see the calculator here. We go 9350 minus 4,500 minus 2,200. 2650. 2650. Now, when you're doing your answers, you can do this crossways like I have with the GST, but as long as your answer's in the square, we're all good. And we'll put that in the current asset. So account receivable 2650. The second you get an answer, you should just chuck it in if you need to, because it's just going to make your life a lot easier. So accounts, or GST, we got GST received minus GST paid, and that GST received also includes sales returns, or the sales return on receivable. Sales returns GST. And then you've got the receivable here. So that will be all part of that. So let's plug our numbers in. So we get the cash and the credit received. So if we go back up, we see credit, or we see the cash GST is 450, the credit is 850. So we go 450 plus 850, minus, and this is the GST paid. That can go in its own bracket. We got cash, we've got credit. So we see the cash was 707, and we see the credit was 700. 707 plus 700 plus the sales return GST, which was 2,200. 200 of that was sales, so the other 200 must be the GST. If you want to work that out, just go 2,200 divided by 1.1. $2,000 in sales multiplied by 0.1 to get the GST, it's 200. And because we're offering that refund, it means we're paying back GST to other people, means our GST goes down, or we're paying that GST out. So let's get our sub numbers up. 450 plus 850 is 1,300. Minus 707 plus 700 plus 200 is 1607. 1607, and we just go 1,300 minus 1607. If it's a negative, like it is in this case, so it's a negative 307, we see that it is a receivable. Remember, you would add the start balance if it's a GST payable or minus if it's GST receivable. Additionally, if there is a payment refund, you would add a refund minus a repayment. Now, dot points up here. If the final answer is negative, e.g. negative 307, then it would be a GST receivable. That's an asset because the ATO would owe you money. So we go GST receivable 307. Look at that. Next, we're going to plug numbers in from previous reports. So we see the bank balance, and we'll make that a green. We see bank balance at end 1073. So we go bank 1073, green. And then we're just going back and forth. So we're just pulling numbers from the green. We see we got net loss, but let's deal with the cash first. So the first bit, van, that will go in our balance sheet because it's a non-current asset. Both of these will go in our asset. These will go in our balance sheet too. Let's see, we've done GST paid, inventory purchase we've looked after, accounts receivable, we've looked after everything else in here. All these were used to calculate. Anything in black text was used to calculate either accounts receivable, accounts payable, or GST, or it went in the income statement if it's orange. We see the van, we see all that, all good. We then look at the net profit loss, and we see another one. So let's include that there. That needs to go into the balance sheet. We've already put these numbers in, and we know where they go. So we go van, and we know that we paid $3,300 for it. Now, it's the only non-current asset because it's the only amount in the investing. Now, because it's an outflow of cash, it means we actually received the asset, so that's where that would go. We've got no non-current liabilities, so the last little bit, I believe, that's interesting. Sorry, I'm just having a look at something. Inventory. I missed inventory. Inventory, and that was given to us beforehand. Oh god. I can't even inventory correctly. There we go. That was given to us beforehand. So we've got our inventory here. That was in the extra information. If you have a quick look up, you'll be like, oh yeah, there it is. See? 900 worth of inventory on hand. And we always go with the inventory on hand. Little pro tip there. So now we need to do the owner's equity. So we go capital at start. Now, normally you would write whoever the owner's name is, but I want to go capital at start, add capital cont, subtotal, less drawings, add, less net loss. There we go. So capital at start, obviously 0, it's a new business. We add a capital contribution of 10,000, which is green, and drawings 2,100. So that will be green there. So if we do a little subtotal, we see that becomes 7,900. The net loss for the period, if we go back up, 1370. So 1370. That's green, and that plugs in there. So let's get our numbers back up and running. 2650 plus 307 plus 1073 plus 900 plus 3,300, 8230. 4,930. 4930. Just gonna double check my accounts receivable numbers are correct. Yep. Checks out. That is not correct. That number should be slightly different. So let's just redo those numbers. 23. Yeah, it should be 2300. I was gonna say. Yep, 2300. Cool. It's always good to make sure your numbers are correct. Fun fact there. 900, 4580 plus 3300, 7880. Next, we've got the 4,700 there. Now we need to just get our numbers sorted there. 10,000 minus 2,100 is 7,900 minus 1370 is 6530. 6530 plus 4,700 will be 11230. 11230. Now we have a difference. Why? What is happening? So we look at it. Why is there a problem? 33500. So we need to find where is this error. Just having a look. Alright, it's quite simple. There is a mistake. I've put the wrong amount here. It should be 1,500. For whatever reason, pick 4,500, and that's because I went cash sales. So we need to fix the amount. And this is a valuable lesson here insofar as you need to be double checking your work. So 9350 minus 1,500 minus 2,200 gives us 5650. 5650. That becomes 5650. That becomes the new number here, and 5650. Now, interesting to say, if you're in a sack, this is one of those situations where if you've got time, go and fix it. But honestly, I'd be taking the L and just go, okay, how do I fix this? If I can't fix it, I would answer other things and just consequential errors, use the numbers you already have, okay? If you have enough time, then you can fix it and it'll all add up. But you've got to make sure you are being careful and using the right numbers. So for example, because I use 1,500, not 4,500, you can see that, hey, that doesn't work. If you look at your number pad, you're going to see 1 is below the 4, so it could have been a mistype as well. That does happen in accounting sacks, but we see it balanced out in the end. So we're going to do a bit of theory, and I'm going to pull some examples. So I'm going to be going back and forth between the balance sheet, which should be centered, and that actually angers me now, and the theory. And then we're just going to do some accounting equation, because assets equals liabilities plus owner's equity. So we see the total owner's equity 6530 plus that liability there. No non-current liabilities. So let's talk about that as well. So elements of the accounting equation slash balance sheet. So we've got asset, liability, owner's equity. And then we're going to talk about revenue expenses. But firstly, assets. So assets are a present economic resource controlled by the entity as a result of a past event, while a liability is a present economic obligation owed by the entity as a result of a past event, that event being a transaction. So important thing to remember here is liability, we owe it, and asset, we control it. Both of them are a result of a past event that can be proven, for example, if you have a receipt for it. And the owner's equity, the residual interest in the assets of an entity after the deduction of liabilities. So if we have a look here, we see our obligations are 7,900. We see our total assets, or the total we control, is 11,230, and the residual interest in the business after we pay our liabilities off with these assets is $6,530. So that's how that works. So if you look at each of these, we get a benefit. So with the accounts receivable, when they pay us back, we get that back. When the GST is fixed and tax is due, we're going to get that much back. We've got this much to spend, and we've got this much inventory we can sell. We also have a van that we can use, and we get $3,300 worth of value from it because that is what it is worth. So that's where that all fits in, and we only owe this much. Now, the reason we didn't include the loan was because that's for February. If you remember the loan right up the top, we see the loan and we go in February. We don't care about February stuff for January. Now, we've got revenue and expenses. So revenues are an increase in assets or decrease in liabilities that increase owner's equity. Think about your sales, that's where that fits in. Likewise with the expenses, that's a decrease in assets or an increase in liabilities that decreases our owner's equity. And we'll apply that at the end. So then we've got current versus non-current. So if you look at the balance sheet, we had current assets, current liabilities, non-current assets, non-current liabilities. Basically, it's a time period. So any occurrence, benefit of a resource, or meeting an obligation that will happen in the next 12 months. So we look at this and we go accounts receivable because they will pay us back within the year. Likewise, we've got accounts payable because we will pay them back within the year. For non-current, any occurrence, benefit of a recess or meeting an obligation that will happen beyond the next 12 months, and you would say a van, a computer, a loan. Okay? So, our accounting equation now, this is how we're going to finish up. We're going to do accounting equation. We're going to go through the assets, liabilities, owner's equity of each one. So the assets, or the info here, purchases worth $1,000 worth of inventory plus GST using cash. So inventory is something we can use. It's an asset. So inventory, Inc. 1,000. We pay cash, so it's bank, decrease, how much, and we've got GST. Now, if we pay GST, that will make our GST go down. So let's go GST payable 100 deck. And I don't have the benefit of arrows, so you're going to have to really switch in. Now, when we buy $1,000 worth of inventory and 100, we've got to pay it all together. So it becomes 1,100. And if we do some quick maths here, we go an increase of 1,000 and a decrease of 1,100 is a net result of a decrease of $100, because positive 1,000 minus 1,100 will give us negative 100. So we'll go negative 100, and we see the net result here is also negative 100. And we see that, yes, this indeed balances. And then if there's no change, we just write no change. And so negative 100 equals negative 100 plus 0. There's your answer. Number 2, the sale of 500 plus GST on credit. If it's on credit, it's accounts receivable. Now, we're going to do this in 2 parts. And now sales is a revenue, so that goes part of the owner's equity because it's an increase in assets, no decrease in liability. So we increase the assets, increase the owner's equity. So we go sales or profit increase 500. Now we are receiving GST, so that means GST payable Inc. 50. And the combined amount of increase 50, increase 500 is 550. But that's not all, because we've got to do cost of goods sold. So below that, we go inventory, decrease 250, because that's the value of the inventory. And that is an expense. So we go profit, and we decrease it by 250. So that's how we're going to treat that. Now, when you do this, make sure you treat this as separate transactions. Now, we see the net increase is 300, so we leave it as a positive. We see the net increase here is 50, and we see the net increase here, 500 minus 250 is 250, and we see, there we go, we see 300 equals 50 plus 250. Nice. Number 3, repayment of accounts payable for $3,000. Now these are all independent transactions. So for this one, our bank goes down. Our bank goes down because it's coming straight out of bank account. 3,000. And we see, it's accounts payable. If we're paying it back, then that must be a decrease as well. And I'm going to make that act pay just so it fits. Oh, it doesn't even fit. Act pay fits though. There we go. And we see 3,000, 3,000. Owner's equity, no change. Remember, if there is a no change, you don't need to put anything. And I'm just going to leave that. I don't need to put a negative there because there's no sum. So negative 3,000 equals negative 3,000 plus 0. Solved. 4. The owner contributes a computer system worth 2,500. So this time the owner is putting in his own computer system. He's paying for it himself, or he's bought it and then he's going to give it to the business. So computer system is an asset because the business can use it. So that's an increase. There we go. And then we look at liabilities, no change, but we see owner's equity, Inc., 2,500. And we just look and we go, oh, it's balanced. So we see that 2,500 plus 0 plus up 2,500, it balances. And then cash received from accounts receivable. So we received $2,000 from accounts receivable, makes our bank go up. Just going to put that there, 2,000. Now, where does it come from? It comes from accounts receivable. Now, accounts receivable is an asset. So if we're being repaid, that decreases the other asset. And we see the net result here is 0. So what happens on the other side? Quite simply, it is no change on both sides. So we see 0 equals 0 plus 0. So that's the accounting equation. If you are stuck on that, I'm going to encourage you to please talk to me about this at any point, because it is just basic math, but once you wrap your head around it, it makes a lot of sense. And this will go a long way into helping you with Year 12. Once again, thanks for following along. It does make a difference. Make sure to share with anyone you know who does accounting. Make sure you like, you subscribe, because there are always videos on this channel. We've got Year 12 accounting. We've also got other hobbies and things that interest me. But on that note, stay safe, look after yourself and each other. See ya.